Hello, 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 and welcome to another Read With Me session. I'm yours truly, Isabel Bedell. I am so excited to read with you this amazing chapter in Psychology of Money. We are almost done with this book. We're on chapter 15. Nothing's free. Okay, straight up, nothing's free. Everything has a price, but not all prices appear on labels. That's a big one. So I'm excited to actually read this with you guys and get into it because this book has been really great. I agree with one of the quotes that the author of Atomic Habits, he was mentioning everyone should own a copy. And I totally agree with that. I totally agree with this because this book has really helped just the thinking aspect of things. Some books are good storytellers and cool, you grasp the concept and you're done. This book allows you to really think and like process what you're reading. And it's also a really just overall great book to give you perspective, and I think that's one of the best things to have, especially in a world where everything in the media is just being like pushed and you don't know what's right or wrong, right? Or what's real or what's not, or who to listen to and who's right, So with that in mind, let's get into it, shall we? I love the weather right now is amazing. I hope you are having amazing weather as well. So with that, let's begin. Everything has a price. Everything. And the key to a lot of things with money is just figuring out what the price is and being willing to pay for it. The problem is that the price of a lot of things is not obvious until you've experienced them firsthand, when the bill is overdue. General Electric was the largest company in the world in 2004, worth $1/3 trillion. It had either been first or second each year from the previous decade, capitalism's shining example of corporate aristocracy. Then everything fell to pieces. The 2008 financial crisis sent GE's financial division, which supplied more than half of the company's profits, into chaos. It was eventually sold for scrap. Subsequent bets on oil and energy were disasters, resulting in billions in write-offs. GE stock fell from $40 in 2007 down to $7 by 2018. Blame was placed on CEO Jeff Inlet, who ran the company since 2001. It was immediate and harsh. He was criticized for his leadership, acquisitions, cutting the dividend, laying off workers, and of course, the plunging stock price. Rightly so, those rewarded with dynastic wealth when times are good hold the burden of responsibility when the tide goes out. He stepped down in 2017, but Imlet said something very insightful on his way out. He said, responding back to the critics, he mentions, every job looks easy when you're not the one doing the job. Every job looks easy when you're the one not doing the job. Okay? Every job looks easy when you're not the one doing the job because the challenges faced by someone in the arena are often invisible to those in the crowd. Dealing with the conflicting demands of sprawling bloat, short-term investors, regulators, unions, and entrenched bureaucracy is not only hard to do, but it's hard to even recognize the severity of the problems until you're the one dealing with them. Emlet's successor, who lasted 14 months, learned this as well. Most things are harder in practice than they are in theory. Sometimes this is because we're overconfident. More often, it's because we're not good at identifying what the price of success is, which prevents us of being able to pay for it. The S&P 500 increased 119-fold in the 50 years of ending 2018. All you had to do was sit back and let your money compound. But of course, successful investing looks easy when you're not the one doing it. Hold stocks for the long run, you'll hear. It's good advice. But do you even know how hard it is to maintain a long-term outlook when stocks are collapsing? Like everything else worthwhile, successful investing demands a price, but its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret. All of which are easy to overlook until you're dealing with them in real time. The inability to recognize that investing has a price can tempt us to try to get something for nothing, which, like shoplifting, rarely ends well. Say you want a new car, it costs 30 grand. You have three options. You can pay the 30 grand for it, find a cheaper one or a used one, or you can just steal it. In this case, 99% of the people who avoid the third option because the consequences of stealing a car outweigh the upside. But say you want to earn an 11% return over the next 30 years so you can retire in peace. Does this reward come for free? Of course not. The world is never that nice. There's a price tag, a bill that must be paid. In this case, it's a never-ending taunt from the market, which gives big returns and takes away just as fast, including dividends. The Dow Jones Industrial Average returned about 11% per year from 1950 to 2019, which is great. But the price of success during this period was dreadfully high. The shaded lines in the chart below when it was at least 5% below its previous all-time high. And this is the chart that he has here. As you can tell, there's a lot of shade in these years, okay? And then it just continuously to go up, 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 up. Okay, this is the price of market returns, the fee. It is the cost of admission, and it hurts. Like most products, the bigger the return, the higher the price. Netflix stocks returned more than 35,000% from 2002 to 2016. That's 16 years. But traded below its previous all-time high on 94% of the days. Monster Beverage returned 319,000% from 1995 to 2018, among the highest returns in history, but traded below its previous high 95% of the time during that period. Now here's the important part. Like the car, you have a few options. You can pay the price, accepting volatility and upheaval, or you can find an asset with less uncertainty and a lower payoff, the equivalent of a used car. Or you can attempt the equivalent of Grand Theft Auto, try to get the return while avoiding the volatility that comes with it. Many people in investing choose a third option. Like a car thief, though well-meaning and law-abiding, they form tricks and strategies to get the return without paying the price. They trade in and out. They attempt to sell before the next recession and buy before the next boom. Most investors with even a little experience know that volatility is real and common. Many then take what seems to feel like the next logical step, which is trying to avoid it. But the money gods do not look highly upon those who seek a reward without paying the price. Some car thieves will get away with this, and many more will be caught and punished. Some things with investing. Same thing is with investing. Morningstar once looked at the performance of tactical mutual funds, whose strategy is to switch between stocks and bonds at opportune times, capturing market returns with lower downside risk. They want the returns without paying the price. The study focused on the mid-2010 through the late 2011 period when the U.S. stock markets went wild in fears of a new recession and the S&P 500 declined more than 20%. This is the exact kind of environment that tactical funds are supposed to work in. It was their moment to shine. There were, by Morningstar's count, 112 tactical mutual funds during that period, and only 9 had better risk-adjusted returns than a simple 60-40 stock bond fund. Less than a quarter of the tactical funds had smaller maximum drawdowns than the Leave It Alone Index, Morningstar wrote. With a few exceptions, aka tactical bonds gain less, They were more volatile or were subject to just as much downside risk as the hand-off fund. Individual investors fall for this when making their own investments too. The average equity fund investor underperformed the funds they invested in by 0.5% per year, according to Morningstar. The result of buying and selling when they should have just bought and held. The irony is that by trying to avoid the price, investors end up paying double. Back to GE, one of its many faults stems from an era under former CEO Jack Welch. Welch became famous for ensuring quarterly earnings per share to be Wall Street estimates. He was the grandmaster. If Wall Street analysts expected a 0.25, like 25 cents per share, Jack would always deliver 26 cents by massaging the numbers. That description is charitable, often pulling gains from future quarters into the quarter to make the obedient numbers salute their master. Forbes reported that one of the examples of General Electric for 2 years in a row sold locomotives in unnamed financial partners instead of end users in transactions that left most of the risk of ownership with GE. Welch never denied this game, and he wrote it in his book, Straight from the Gut. The response, he mentions in his book, the response of our business leaders to the crisis was typical for the GE culture. Even though the books had closed on the quarter, many immediately offered to pitch in to cover the earnings gap. Some say that they would find an extra 10 million, 20 million, and even 30 million from their businesses to offset the surprise. The result was that under Welch's leadership, stockholders didn't have to pay the price. They got consistency and predictability, a stock that surged year after year without the surprises of uncertainty. Then the bill came due, like it always does. GE shareholders have suffered through a decade of mammoth losses that were previously shielded by accounting maneuvers. The penny gains of Welch's era became dime losses today. The strangest example of this comes from failed mortgage giants Freddie Mac and Freddie Mae, which in the early 2000s were caught underreporting current earnings by billions of dollars with the intention of spreading those gains over the future periods to give investors the illusion of smoothness and predictability, the illusion of not having to pay the price. The question is, why do so many people who are willing to pay the price of cars, houses, food, and vacations try so hard to avoid paying the price for good investment returns? The answer is simple. The price of investing success is not immediately obvious. It's not a price tag that you can see. So when the bill comes due, it doesn't feel like a fee for getting something good. It feels like a fine for doing something wrong. And while people are generally fine with paying fees, fines are supposed to be avoided. You're supposed to make decisions that preempt and avoid fines. Traffic fines and the IRS fines mean you did something wrong and deserve to be punished. The natural response for anyone who watches their wealth decline and views that drop as fine is to avoid future fines. It sounds trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around for long enough for investing gains to work in your favor. Few investors have the disposition to say, I'm actually fine if I lose 20% of my money. This is doubly true for new investors who have never experienced a 20% decline. But if you view volatility as a fee, things look different. Disneyland tickets cost $100, but you get an awesome day with your kids and you'll never forget that. Last year, more than 18 million people thought that fee was worth paying for. Few felt that $100 was a punishment or a fine. The worthwhile trade-off of fees is obvious when it's clear you're paying one. Same thing with investing, where volatility is almost a fee, not a fine. Market returns are never free and never will be. They demand you pay a price. Like any other product, you're not forced to pay this fee, just like you're not forced to go to Disneyland. You can go to the local county fair where tickets might be $10 or stay for free. you might still have a good time, but you'll usually get what you pay for. And same with the markets, the volatility, aka the uncertainty fee, the price of returns is the cost of admission to get the returns greater than low fee parked like cash and bonds. The trick is convincing yourself that the market fee is worth it. That's the only way to properly deal with the volatility and the uncertainty, not just putting up with it, but realizing that it's an admission fee worth paying. There's no guarantee that it will be. Sometimes it rains at Disneyland, but if you view the admission fee as a fine, you'll never enjoy the magic. So find the price and then pay it. This reminds me of the investment that we have in our community where we invested in the drip token. And it's basically like every time that you actually take out money or you claim an amount, you have to pay a 10% tax. That's what they call it, right? And then when you convert drip into, let's say, USD, which is a stable coin, then you have to pay an additional like 10%, sometimes 12% just to get that conversion. And it's like ridiculous, you know, when you're looking at it, like if you're, let's say, taking out $1,000, you're literally paying 20% of that, which is $200 just on fees or fines or taxes or tax or whatever. And then that's gone. And now you only are left with like 800 versus 1,000. So like, if you look at things like that, and if you look at it from this perspective, like that is just the price to pay to get that type of investment back. I mean, if you look at that, that's not that bad. You know, it's like I would rather very much pay that than not have to pay that and not be involved in a project or not be in the arena playing, you know, and just be a person on the stands commenting without having any experience, you know. And I think that's the price to pay. Like, just like if you were on a football team and you're the one, you know, moving the ball and tackling people, you're the one getting the hits. That's the price to pay. And being in the arena, but you get the biggest reward. You get the admiration from the crowd. You get the payment to play with your passion. You know, you get so many different rewards that it might feel like, oh, I have to pay this price, but is the price worth paying for if that's something that you're passionate about, if you believe in it? So next time you're going to be investing, take a look at those type of examples and ask yourself, what is the price? You know, even if it looks free, it's definitely not free. There's always a price. So take a look at that. Always take a look at what's the hidden gem that's not being said up front, you know, and ask yourself, am I willing to pay that price? Okay. In the next chapter, we're going to go into you and me. Beware taking financial cues from people playing a different game than you are. That's going to be a good one. And I'm excited for that. I'm really excited for this one. All right. I'll see you in the next one. Talk to you soon. Have a blessed day and see you later. Bye.